I wonder what's up on YouTube. Let's have a look. Oh boy, here we go again. If you watch finance and investing videos on YouTube, chances are you are constantly getting new recommendations on the subject every time you enter the platform. A recurring theme that I see a lot these days is, well, this. Videos like this are recommended to me by the YouTube algorithm almost every single day. Over and over, I get bombarded with these quite appealing videos talking about an upcoming market crash. At first, I used to click on them a lot. Investing has risks, and just like anything with a certain level of risk, it may pose a challenge to our emotions. When you put money into the stock market, regardless of what asset class you're investing in, you factor in not only the asset's past performance and its current conditions, but also a forward-looking element, that is, the expectation that it will gain value over time. For that reason, it's only natural that you worry about the possibility of an upcoming market crash. Nobody would make an investment today if they knew for a fact their investment would lose 30% of its value the following day. And that's why videos such as this are so appealing. Every investor would love to know the future. If we had the ability to know exactly when the stock market is going to crash, one could rest assured we'd never lose money from our investments. However, despite all that, I simply do not click these videos anymore. I've had enough. There are 3 reasons why now I absolutely despise market crash predictions. 1. The market is cyclical. Yes, a market crash will come. That's guaranteed. That statement is true and always will be regardless of when it is stated. The market will eventually suffer some sort of correction or even a crash, and that's something we simply have to take as a fact. That's why, in a sense, all these predictions are trivial. Some of these YouTubers have been playing the same tape over and over again. It's such an easy statement to make and requires no particular skill to do so. Just like a stopped clock is right twice a day, history has showed us it will turn out to be right. Some sort of market crash or correction will eventually take place anyways. What they can't predict is when it's going to happen. Nobody can. Not even the best investors. Just listen to this.
The bad years, the crisis years, the Dow dropped by about 50%, and since then and people panicked and got out, of course, even in the mutual fund business, and particularly in the ETF business, a lot of net liquidations at the lows, and now we're back. I think the gain from that level is maybe 200%. So it shows you that when you act on the emotions of the marketplace, you're making a big mistake.
2. It actually doesn't matter that much. If you follow a fairly hands-on approach when it comes to investing, a market crash is of great relevance to you. After all, every active investor will somehow have to time the market, at least to some degree. However, if you follow a passive approach by pound cost averaging, that is, if you invest a given relatively small amount every month for a long period of time, market crashes kind of lose part of their significance. Now, don't get me wrong, no investor under the sun can be fully indifferent to a crash. But if you accept that cyclical corrections and crashes are inevitable, if you have a well-diversified portfolio mostly made of low-cost index funds and ETFs, and if you believe, like history has always proved right, that despite all crashes and corrections, the market will eventually trend upwards, then worrying too much about an upcoming market crash is kind of a waste of energy. If you have a strategy and you believe in it, then by all means stick to it. There's a great deal of academic literature suggesting that your chances of success are greater than those of active investors. Everything else around you is just noise. Keep working towards your goals as you have been doing so far. Sit back, relax, have one of these maybe, or this one. or this one, or, whatever. 3. Predictions are kind of pointless. Predicting a market crash always turns out to be right, eventually. That's just how the market works. There will be ups and downs along the way, but nobody can predict when a crash is going to take place. Now, that doesn't prevent pundits and so-called financial experts from trying to predict when the next crash will hit. But here's the thing, more often than not, they are totally wrong. In a study conducted by the CXO advisory group that tracked a total of 68 financial experts that produced a total of 6,582 market time and forecasts between 2005 and 2012, the average terminal accuracy of these forecasts turned out to be an appalling 47.4%. Literally, on average, they were wrong more often than they were right. If you look at the table showing us the individual performance of each guru, the number gets even more embarrassing. Only 24 out of the 68 experts were not wrong more often than they were right. Some gurus even turned out to be right less than 30% of the times. This is shocking. In short, if a group of highly trained financial professionals are so good at failing, what are the chances of these random YouTube guys being right? I don't see a point anymore. Therefore, I just refuse to waste my time with this type of videos. Conclusion. I strongly believe that over the long run, I'll be better off if I just ignore all these apocalyptic predictions. If the market goes up, I'll keep buying. If the market goes down, I'll also keep buying. It's as simple as that. So when people come to me saying that the market is about to go down the toilet, I just say,
Shut up. Shut up. I don't care. I don't care.
With that said, do keep in mind there isn't such thing as a perfect strategy. The suitability of a strategy depends on the specific circumstances of the investor. This is the strategy that suits me best. And in my opinion, it is what makes sense to most new investors, especially those on a low income. Some investors are strong critics of this cost averaging strategy, and there are valid reasons for that. But that's for another video.